Worried about how extreme markets have become? Because right now, it's just a handful of US tech stocks that account for roughly 40% of global equity market value, and most of them aren't even paying a dividend. At the same time, the fallout of the conflict in the Middle East is driving volatility, inflation is a reality almost everywhere, and investors are starting to ask a more urgent question. What can actually protect my portfolio in a market like this? Because the obvious solutions don't seem quite so obvious anymore. Welcome to Fidelity Answers. Hello, I'm Seb Morton-Clark, and this is the podcast where we tackle the questions investors are asking of the people managing their money. Today, in a market this concentrated, where are the genuinely clever defensive options for investors? Well, I'm very happy to be joined today by several people with strong convictions on where to look. Tristan Purcell is an equity fund manager in London. His strategies are all about the long-term, stable, income-producing stocks that tend to shore up portfolios when markets go off kilter. Alex Laing is also an equity fund manager. He focuses on climate solutions and a lot of power and utility-centric investments that perhaps in the past were somewhat stodgy companies, but now well positioned to benefit from the energy transition. And last but not least, to provide some asset class balance, Rebecca Motta is one of Fidelity's directors of research for fixed income, in charge of teams of analysts who look at the bond market and credit markets. Welcome to you all.
Hello. Hi there.
So I'm going to start, Tristan, with you. I mentioned the growing concern in the intro about concentration. Is it a valid concern?
I think so. So, the US is now nearly 70% of global equity markets. And even within the US, about half of it is in tech, as you mentioned. So that's around 40% of the global market in these US tech companies, most of which, from our perspective, they don't pay a dividend over 1%. So for us, it's a huge chunk of the market that we don't really look at. And if you look back historically, it's not always been the case that the US is the best place in the world to invest. It seems to be perceived that way today. But if you think back to the early 2000s, you had a period where the rest of the world was outperforming the US. You had the rise of China, and that flowed through into Europe, resources companies and so on. You look back at the early 80s, or most of the 80s, Japan was the only place that was seen to be worthy of investing. At the time, Japan, I think, was 20% of global GDP, roughly, and it was actually 40% of world markets. So you compare that today with the US at 70% of world markets, and it's still only 25% of GDP. I don't think, and I need to tell anybody how investing in Japan in the late 80s or putting 70% of your capital, half your capital in Japan in the late 80s would have worked out. So I think markets do obviously go through periods of incredible concentration, and it's worked well for a very long time to be in passives and to follow the benchmark. But clearly putting all your eggs in one basket is not necessarily the best thing to do.
Now, of course, in the past, investors would have perhaps approached a market like this by rotating into, as we call them, more defensive sectors. How has that worked recently?
So for us, we don't try to create a defensive portfolio by just taking large top-down allocations to the defensive sectors like staples, utilities, pharma, and so on. Because if you do just take these big blanket allocations there, you can still have something come along and hit you or hit the whole sector at once. So last year, or the last couple of years, for example, we had RFK and all the tariffs and most favored nations policies hitting pharmaceuticals. So even though it's a defensive sector, it still got hit. So what we try to do is create the defensiveness in the portfolio company by company. So our two biggest sector weights are financials and industrials, obviously, which are cyclical sectors at the aggregate level, but you have to look within that to see what we actually own. So within financials, for example, at the aggregate level, that's a cyclical sector because of the banks, but we don't own any banks. What we own is financial exchanges, which benefit when there's lots of volatility because people trade more. And insurance companies. And even within insurance, you have to go a level deeper because life insurers, we don't own any. They tend to be more bounced around by bond yields. We own lots of non-life insurers. So the likes of the car insurers, which obviously their earnings depend on how often people crash their car. And then the reinsurance industry, which is dependent upon the weather largely, whether there's hurricanes or not.
Okay. Very good. Well, we're going to come to some more of that. Now, Alex, you've been involved in some of the stellar gains of the past year. Have they made you uncomfortable about valuations in any of the sectors that you tend to look at?
I think following on from everything Tristan was saying, there's pockets of the market that have shown a sort of highly concentrated nature. And in those pockets, valuations have become very extreme. mean, there was a lot of debate even a year ago about the nature of the AI bubble, or so-called bubble, whether it was a bubble, what it would turn into, how long the duration would be. And if you had a relative tolerance for risk reward, you could still pick up a number of pretty attractive bargains even then. That is definitely a tougher pool to pick in today. And that goes for the, even the so-called defensive names that have exposure to that. I find it harder and harder to get the traditional value investor margin of safety when you're buying into some of those names. So yes, that has certainly become more difficult.
Okay, and we're going to get to those pockets that you have been spotting shortly. But so the equity view, this is one way into the debate, but the other textbook place for investors to allocate is fixed income, of course. Now, Rebecca, it's not been, in some respects, not been an easy year for debt markets, but there are people obviously still allocating to fixed income right now. So can you just give us what's the broad argument for doing so at the moment?
Sure. It's not been the easiest year. Obviously, there's been a lot of volatility and a lot of headline risks. Obviously, geopolitics have played an important part so far in Q1. But also there's been a lot of debate on AI and the software sector. So far, however, actually bond market had delivered steady returns this year, and we expect that to continue for the rest of the year. Credit spreads are quite tight in a number of asset classes, both in investment grade and high yield. However, total yields are still quite attractive because clearly sovereign bonds offer decent returns. We have yields of above 5% for US investment grade and almost 4% for European investment grade. So again, for income seekers in fixed income space, these are still attractive returns. We think there's going to be a lot of idiosyncratic risk on the rise. So it's not just about buying the market, but really focusing on some pockets and specific credits. So we think credit markets will remain supported for the next 6 months by strong fundamentals and good earnings. And from the technical picture, we think the high yield market is going to be on the positive trajectory with lower issuance over the summer months. However, in investment grade, we still see a lot of issuance coming from AI, so the hyperscaler, but also the entire AI-related ecosystem. And this could lead to spreads not tightened materially from now on for the rest of the year.
So what's the view then on this issuance of the AI exposed debt? Because you mentioned the hyperscalers and you mentioned that credit markets are tight. But are those investments priced as highly as the rest of the market?
Hyperscaler issuance and in general AI tech-related issuance has changed already the credit market so far year to date. So for example, the US investment grade index, the technology sector weight in it has grown about 3% to about 10%. So now technology is the second largest issuers after financials. And also in the sterling investment grade, with a large issuance from Alphabet earlier this year, now Alphabet is represents almost 1% of the sterling investment grade index. So clearly, also the shape of the indices is changing dramatically. The hyperscaler tend to be highly rated. A lot of them are AA's or above. And so they improve the credit quality of the index and of the investable universe. But they also come at attractive spreads for the credit quality. And why we think, obviously, there's been a lot of issuance, and we expect next year to be in excess of 200 billion. This issuance is coming from issuers with strong balance sheets and with strong cash flow. So we think that given the spreads that are on offer, this is still an attractive place to invest. And we also note that the hyperscaler are also more and more looking for capital funding in the equity market, not only in fixed income market. And we think the convertible market is also going to be a source of resources given the massive capital needs.
So there's almost a counterintuitive argument here where we're talking today about sort of looking at defensive options that might protect you against a sort of a toppy AI story. Actually, what you're saying is that some of these big AI names, the big hyperscalers, are worthwhile investments because of the business models that they run.
Yes, and because of the strength of the balance sheet and the cash flow. However, because of the massive and the sheer amount of issuance, investors need to remain tactical in how they approach it in terms of being able or trying to time when is the best opportunity to invest in these credits.
Okay. Now, Tristan, what are the long-term opportunities that you've been spotting in equity markets? And what I want to get to here is that those opportunities have been a direct result of this huge shift which we've seen into AI. What are those opportunities? And to what extent do you think that those can hold up if the AI story falters?
If I just try and put a theme around a lot of the opportunities we've seen, I'd bucket them as sort of a lot of the quality companies that have done fantastically well for 10, 15 years post the GFC. A lot of quality strategies benefited from that. They steadily re-rated throughout that decade, 10 to 15 years. And in the last year or two, they've all derated really aggressively, very, very quickly. So some of those are the AI losers or perceived AI losers, like the software companies, where they now look extremely cheap compared to any historical reference point. But you do have to acknowledge that the range of outcomes for them is much, much wider than it used to be. But there's also lots of other things that are caught up in that derating, that quality loser or quality derating that we've seen, like medtech, luxury companies, some FMCG companies, things that have historically been far too expensive for our tastes, didn't pay decent dividends or re-rated to the point where they were so small. And they've now sort of fallen into our universe. So we think a lot of the interesting options out there are now in that bucket.
If we were thinking about what a clever version of defence might look like to you, given some of those areas that you've just mentioned, how is that story playing out for you this year as an investor?
Well, so you can lose money in two ways. You can either lose it in the fundamentals deteriorating or by paying too high a multiple and multiple collapsing, even if the fundamentals are intact. And so at the moment, there's obviously lots of enthusiasm around the AI parts of the market, but the risk there, even if the fundamentals hold up and hyperscalers keep on spending, is that the multiples are too high and you have a big sentiment shock. So you can still lose money there. And I think where perhaps we've finding more interesting things is actually in some traditionally more cyclical things, some industrial companies, where the multiples are quite depressed and maybe the earnings side is actually the more volatile piece of the equation normally. But today, because the multiples are so low, we think they still offer a decent defensive opportunity.
Okay. Alex, I want to come back to something you mentioned earlier, which is about these pockets where you've been finding value despite the sort of concentration that we've been seeing. Where do you think things might be bottoming out at the moment? Which sectors are you looking at closely with a sort of eagle eye?
I mean, there's a lot of cyclical sectors that, Tristan referenced the attractive multiples, but there's a lot of cyclical sectors where the end demand has been very weak for the past few years. So, you'd single out the autos complex, certainly anything related to construction, both, really globally, US, certainly China, Europe. And we may not be quite yet at the sort of point of green shoots, but we do seem in many of those categories to be at least hitting trough and not getting any worse. And particularly for businesses where there is idiosyncratic self-help or multiples are overly depressed, as Tristan alluded to, you can have confidence that the returns are good enough in the medium term to carry you through until the market does improve. And every cycle carries the seeds of its own demise, effectively, and a down cycle drives an up cycle eventually, simply because of the dynamics of supply demand. And so we can have some confidence that at some point it will improve. And so in those cases, there can be some very attractive opportunities.
Utilities is another place where the conversation has changed, but for different reasons. Lots of those stocks have actually done quite well. And now, is that just because the power industry is an AI proxy?
You referred to utilities earlier as a sort of traditionally stodgy industry, and I think that's exactly how people perceived it. And then there was this remarkable change in perception that started a couple of years ago when utilities and the power complex really arrived at the sort of the epicenter of the AI complex, particularly because it is one of the major bottlenecks to the development of data centers, which are obviously the building blocks of AI. And that definitely persists today. And so if you do fall into the bullish camp on AI, then utilities offer an attractive way at a reasonable valuation and with a defensive nature means to sort of play that as a theme. I'd push back on them being solely an AI play. And although I have no doubt that, on a DeepSeek day equivalent, DeepSeek Mark II, that some of those names would sell off, I don't think the fundamentals are as correlated to the pure play AI complex as sometimes people make out. I mean, often people will point to the investments that are being made in grid capex, for example, which is driving a step change in utility networks growth from pretty moribund, flat or even declining asset bases into what can be double digits, even above 20% growth in compound growth rates in the asset base. And that predated a lot of this AI spend. If we take examples of Denmark, for example, which really set the blueprint for what a lot of these networks have done. Its mileage of transmission networks has pretty much doubled in the past 15 years. Its capex investments from its main transmission operators have tripled. That was not because data centers happened to be being built in Denmark before anywhere else. It was because it was the sort of progenitor, effectively, of the energy transition that we are seeing in a number of countries. So that would include the adoption of EVs, particularly the adoption of renewables. I mean, Denmark went from a very, very heavy fossil fuel-powered system, particularly coal, into a market where it's almost pretty much exactly 50% offshore wind. And having to deal with the dynamics of that, fluctuating flows, sites for your power that are out to sea rather than right by your cities, changing means and where consumers demand their energy, that's what drove that change. And that change is really in its infancy in many other markets. And so I think although AI is the cherry on the cake for a lot of these businesses, it isn't the be-all and end-all of the investment case.
So what would happen then to the sector if we did see a loss of confidence in the AI rally, if the bottom dropped out of that story?
I think if the bottom dropped out of the AI complex, there would be a lot of short-term volatility, and I wouldn't like to necessarily predict how some of those names would react in that. But what I like, particularly as a sort of long-term investment house, is, we can ride through the short-term vicissitudes of the market if we can believe in a long-term or even just a medium-term story and investment case. And I think that is absolutely the case here.
Following that logic then, is if they're not about the AI trade, or not fully, as you say, the cherry on the cake is very nice, does it mean they might have maxed out already then?
Well, a lot of the utilities names have had a relatively weak 2026 so far. They had a very strong year in 2025 and indeed 2024 on the back of this theme. But an environment of rising rates, particularly, as we were talking earlier, the concentration in the market, particularly in the tech sector, which has really outweighed gains elsewhere, has meant that utilities as a sector has generally been a weaker relative performer so far this year. So I don't think you're buying it necessarily at the highs. And they've slightly fallen out of the crosshairs of the market when discussing AI. That's in part due to the excitement around areas like memory and semi-cap spend that have really been sort of dominating the narrative in 2026, but also because near-term solutions, particularly in the US, where they haven't been able to get the power to data centers, have been this so-called behind-the-meter power supply. So that would be setting up smaller, localized, individualized sources of power to provide energy for specific sites. So that might be through diesel engines or aeroderivative turbines that don't feed off the network. And that means that these utilities haven't been anymore at the forefront, as I said earlier, at the epicenter of the debate. That is a short-term solution. These are very uneconomic solutions and just logistically difficult. I mean, there are data centers where literally hundreds of trucks a day are having to arrive to provide fuel for diesel engines. That is not a particularly good way of running a data center. And so in the long term, utilities will have to step back in. And that is, a significant opportunity for growth in the future.
Now, Rebecca, there's lots of smaller companies engaged in AI-related activity who are also issuing debt now. Is that a pocket of value worth looking at? Is there anything defensive there, or would you say perhaps that these are still too risky?
A couple of examples I can think about. So data center issuance has also been a big factor in credit markets this year, both in investment grade and high yield space. Very still, all of these businesses are fairly new. So there are still a lot of work to be done, especially on corporate governance. Many of these companies, or a few of these companies, didn't exist very many years ago, and some of them also converted from being crypto companies into data center companies. There are also a lot of question marks about the need for investment and the returns that as investor we need to believe in order to think about investing in these credits. So far, I would say that on the data center issuance, we're treating it still with a little bit of caution and to assess which credit to invest in, but overall cautious also on the corporate governance and cash flow predictability and when they will arrive. On another point related to what Alex mentioned earlier, there is on the utilities front, on the US side, clearly the electricity demand increase coming from AI is visible, is there, and clearly the utilities have to invest a lot in order to increase the transmission lines and improve the grid health and strength. The U.S. utility space is very big. For example, they issue about $150 billion per year. So it's a very important part of the investment grade market. And from that perspective, we are actually constructive on the sector because the regulatory environment is supportive. And also from the equity side, as long as the regulator allows equity investor to earn an appropriate return on the investment, this means that the investment will flow through the asset base and they will be remunerated accordingly. Therefore, yes, the U.S. utility space is another sector that where the issuance is coming as a derivative of the AI investment cycle, and this is something where we are constructive on.
Okay. All right. Well, we've heard about utilities and debt, and how about another traditional defensive play, and that's healthcare. Our producer, Patrick Graham, spoke to analyst Emma Newey-Clark.
So I'm here with Emma Newey-Clark, who's a healthcare analyst on the equities side at Fidelity. Emma, welcome.
Thank you for having me. Let's
start from the beginning. How have healthcare stocks done throughout this period of sort of AI and tech boom over the past 2 years?
They've suffered. There's clearly been a rotation out of healthcare into tech. It depends slightly which subsectors you look at in healthcare, in that pharmaceuticals have done a bit better. They acted a bit more defensively, but if you look at the sector as a whole, it's massively derated. There have been some idiosyncratic issues within the sector, but if you look at many areas of healthcare, they're almost cheaper than they've ever been now.
Does that mean opportunities have appeared in that case? Do you think there are places where there's like lots of value in healthcare stocks now?
I mean, it's hard to say when they might work, but there are definitely areas where, you look at stocks that are mid to high single digit growth companies, cheaper than they've ever been on an absolute and a relative basis. Particularly if you look at some of the medical devices, yes, you can question some utilization trends, and maybe there are some things that are a bit softer than they were. But as a sector, these companies that used to trade on pretty healthy multiples, the derating in them does look like it's now got to a pretty extreme level, albeit can you call a bottom if AI keeps continuing to, suck the energy out of the room?
So I suppose that's the key question here that we're asking this month is there a case for healthcare now? Is there a really strong case for healthcare as a sort of hedge on everything else that's going on in the market?
If there's a stumble in AI and tech, healthcare will definitely outperform. I look at some of my, pharmaceutical companies where, pharma has its difficulties as long-term investments, but equally there are many companies that you can forecast growth for a decade that regardless of what AI or the economy will do at pretty reasonable valuations. And so I would expect those areas to significantly outperform if there is a pullback. It's always hard to say with healthcare, is it as a sector really cheap? It does have challenges that tech don't. You can't just magic up $1 trillion in new industry within healthcare because someone has to pay for it. So, they are constrained by budgets and price cuts across the sector, which is always going to make it a harder sector to invest in, but equally they're never going to collapse. I think as people are becoming more aware of how far tech has gone, they do definitely start looking at sectors that haven't kept up and which ones will be more insulated. And I think particularly if you're looking at defensive sectors, consumer staples and consumer, there's a lot of concerns around that. So I think, pharmaceuticals in particular does come up as an area where it will kind of act differently to other parts of the market.
Are there things that you think may come to fruition in the sort of second half of this year?
So, we've got a lot of big pipeline readouts for some companies later in the year. When I'm talking to portfolio managers, it kind of depends what profile they want. Do they want something where you're trying to look at the risk reward on pipeline success and like hope for some bigger upside? Or are you just looking for something where you can kind of feel happy about and confident in the growth profile, that it's relatively known and you feel the valuation's appropriate? And then there are obviously there are some companies that, are very cheap, where there are a lot of concerns. And so, some people like to go look at those because often that's a great time to invest in pharma, where everyone's decided that the company's left for dead as their big product, let's say, is going off patent. And then you find that it will survive and there will be new products that can cause it to grow again. So it kind of depends. Are they looking for, they've got a whole load of NVIDIA and they're just looking for something that won't blow up if AI blows up, at which point they probably don't want to take a big pipeline catalyst, or pharmaceuticals and healthcare a bigger kind of focus for them and they're looking for stocks that can kind of lead to upside. And similarly, there's biotech where you can go even higher risk, higher reward if you go earlier stage, and different fund managers will look at different things.
Emma, thanks very much.
Emma Newey-Clark speaking earlier to Patrick Graham. Now, Tristan, we heard Emma there running through some of the types of healthcare and pharma stocks that different portfolio managers might be looking at. So to use her term, what is the profile perhaps that you're watching for or looking for in that sector?
So we're more on the defensive end of what she mentioned, i.e. we're not looking for the biotechs that might have spectacular upside. And actually, I think we found that even some of the larger pharma companies, you're still heavily dependent on just a handful of drugs. So as they roll off patent, you've got to refill that pipeline. You've got to use the pipeline to refill that revenue stream. If you're doing that through organic means, i.e. through R&D, that's quite hard to predict. We obviously have a huge team, of which Emma's a part, that help us do that. Or they have to go out and spend on M&A, buy new pipeline drugs to refill that revenue stream. Both of those options we don't particularly like. We much prefer the companies that are very diversified across a range of drugs, where you're not dependent on one drug or that one drug going off patent. So we prefer the defensive mix. And then I'm glad she also mentioned medical devices. That's an area that I mentioned earlier, medtech, where we are finding more opportunities. These are still good companies, despite the fact they've derated a lot. They just don't happen to be in the markets. They're not the apple of the market's eye at the moment.
Alex, I just want to ask you quickly as well. What do the analysts know to bring you? What are you looking for at the moment from the research team?
So having come from the analyst team myself, I have a very healthy degree of respect for the quality of research the analyst team provide. And it is probably the single biggest contributor to my own process in terms of screening for new stocks, keeping detailed coverage on the names I own, and rotating assets within the portfolio. I do have my own natural biases. I would class myself more at the value end of the spectrum, although that's certainly not sort of deep value at all. And I'm happy to own growthy names as long as I believe there is that margin of safety. So analysts in general know the type of stock I'm looking for. But fundamentally, because I work in thematic spaces, the picking pool is much smaller. So my climate solutions universe, there's probably only 500 names I can realistically own globally. So within that, if an analyst is upgrading a name or pushing a name, it's very clear that that's something they should be bringing to me and do so. And then we can have a healthy debate about the relative appeal of that stock versus other opportunities, or indeed the names that are currently in the portfolio, and then go from there.
Excellent. Okay. Well, it feels like a good place to draw things to a close, but not before we've played our game of hot cakes and hot potatoes. What would you buy like a hot cake, and what would you drop like a hot potato? Rebecca, I'm going to start with you, please.
Okay. So in the buy category, I think for the next few months, single Bs in European high yield are a good spot. They're quite attractive versus double Bs. And as we said, we expect stable and solid earnings, a positive technical picture, and especially in European high yield, there is very little component from technology or potentially AI losers.
Mm-hmm. And your hot potato?
On the hot potato, I would say flipping the coin. In investment grade, there are potentially AI losers, AI exposed names where valuation don't reflect risks. So that's quite an easy one to avoid.
Okay. All right. Tristan, your hot cakes.
So my hot cake would be the broader Japanese equity market, I think. There are a lot of companies there that, this governance reform came in maybe 5-10 years ago. It's only now really you can start to see it. You're starting to see material buybacks. You're starting to see return on capital targets and their incentives and so on. And that is really starting to have an impact.
Excellent. All right. And your hot potato?
My hot potato would be the space complex, where there's, when you have to draw your TAM based on things that are on other planets and that are many decades into the future, that's a very, very long way from our comfort zone.
So a bit far afield for your taste then, Tristan. Very good. Okay, so Alex, your hot cake.
My hot cake would probably be very sort of specific parts of the battery value chain. Mm-hmm. I think people really underestimate the economic improvements that have been made in the price of batteries, and that the applications that better economic equation sort of opens up. And I think that space in certain verticals has an unbelievable avenue for growth.
Okay, and hot potatoes.
I hate to jump on Tristan's spaceship, but I think I would be tempted to do the same. I find some of the TAM debates to say that your addressable market is all of space would be rather like a logistics company on Earth saying that my TAM is the entire globe. So I think, yes, it's a bit difficult to get my head around some of those valuations.
Well, clearly no one here has been watching enough Star Trek, but that is all we have time for. So thank you to my guests, portfolio managers Alex Laing and Tristan Purcell, and Director of Research Rebecca Motta. And thank you for watching. You can find more on the topics covered on your local Fidelity website or at fidelityinternational.com. And if you've enjoyed this episode, please like, share and subscribe. The producer today was Patrick Graham, with production support from Connor Bailey and Rachel Reed. We'll see you next time, but for now, from all of us at Fidelity, goodbye.